We're still looking at gains since Election Day, obviously, but stocks are coming off of their worst day yesterday since September, falling on concerns over President Trump's ability to deliver on certain policies, given struggles with support for the GOP health care bill. Markets are up 12% since Election Day now on the Dow Jones Industrial Average. Joining us right now, Janney, Montgomery, Scott, Chief Investment Strategist, Mark Luschini. And Mark, it is good to see you. Thanks so much for joining us.
Thank you, Maria.
What do you do here, knowing what you know in terms of the policies coming out of Washington and what we just saw yesterday as an investor?
Sure. Well, Maria, we've actually been urging some caution to investors for about a month and a half at this juncture, given the parabolic move we've seen in the stock market, and particularly in some subsectors of the stock market that got way ahead of themselves with regard to making down payments on the part of investors, buying forward expectations of everything that was going to be converted from campaign fodder to legislation, all within about 100 days after inauguration, and we didn't think that was likely. So we suggested that what we saw yesterday would in fact happen, which is some pressure coming into the equity markets as a consequence of the prospects of some of this legislation being delayed, particularly the most market-friendly reform of all, which is corporate tax reform, which seems to be getting a little bit of a push out by way of this health care project that seems to be lurking out there that's a little messier than what was anticipated.
Do you think this is the beginning, then, of a rough moment for stocks here?
I think it could be. You know, the market is vulnerable. We're trading at 18 times forward earnings for 2017. Some of the sectors that sold off the most were those that were most overbought and were well above their long-term moving averages. So, you know, any kind of pullback here of maybe on the order of 5% or so, or 6 to 7% would not be uncommon. In fact, it'd probably be welcomed by investors. I can't see why it would be more nefarious than that necessarily, because the underlying economic fundamentals remain sound.
Mark, even if the House gets the health care bill through tomorrow, do you see the markets moving back up, or is the cat out of the bag here? Is the policy messiness just out there now, and investors are going to be a little more cautious, even if you get a small victory like the bill moving through the House?
You know, I think that's a great point. I think literally the market could turn back up again if, in fact, we saw that the legislation with regard to health care reform turned around and was enacted that quickly. I think there's enough sideline investors, enough investors in general interested in being long in this market, being fearful of being put behind the benchmark 8 ball by way of not staying long in this equity environment, that they'd be willing to come back in, realizing that if, in fact, we could see past the health care reform, that next on the docket would in fact be corporate tax reform, and that's what the market really wants to see.
How much patience, though, does do investors have in terms of a timetable they're looking at for these tax cuts and tax reform?
Well, not a whole lot, because again, you know, the market's trading at 18 times, about $130 of earnings that's expected for the S&P 500. Estimates with regard to what the windfall could be from corporate tax reform is on the order of, call it, $10 to $12. So the more the market would likely advance in anticipation of corporate tax reform, that without it means it's trading on $130 of earnings, means once again the market's increasingly ripe for a pullback on any kind of disappointment. Not necessarily bad news, just disappointment. So it isn't going to give a long leash to corporate tax reform if, in fact, we don't see it occur before August, but rather look at it as more of a fall event and maybe, in fact, be something that trips into 2018 instead of having any kind of impact, positive that is, in 2017.
Mark, Kirsten here. So a lot of commentary coming out of yesterday, right around the closing bell, was that, you know, on the floor, people felt like this was healthy, right? That the stock market has been going up for so long, and that part of this adjustment and reaction was really, it hurt, but overall it was healthy. You know, what is your take on that?
Well, I agree. I think there are a lot of investors that were sort of paralyzed by the fact the market kept going up and up and up without so much as a pause, and were reluctant to chase it, but at the same time we're increasingly becoming agitated by sitting in cash and watching it going up and seeing the opportunity cost of not being long this market become increasingly more rich. And so I think any kind of pullback is going to be particularly short-lived, because there is that pent-up demand to get long in this market, and we won't see something more sinister occur.
Well, look, the earnings picture obviously supports the stock market. We had two misses last night. FedEx and Nike both missed expectations. We're watching those stocks today, but we were expecting earnings growth in the double digits even without tax reform this year. But now obviously it's all about policy. How do we protect ourselves? What do you do today, considering that we're expecting further selling?
Well, I think a couple of things, Maria. I think one, put a shopping cart together. You don't have to be invested in those sectors that I think remain vulnerable to further selling, which would be those that were geared toward all the things the Trump administration was going to accomplish early on in its administration, that being materials, sectors like financials, particularly the banks, not the asset managers and custodian banks. We like those in here. Some of the industrial names as well. And instead, look at healthcare. Even look at some of the beaten down energy names in here. In addition to that, look overseas. I mean, European equities finally are becoming a rewarding experience for investors. We've advocated a position there for so long, and if you look at the Euro stocks, it's actually ahead of the S&P 500 on a year-to-date basis, and the earnings profile for European companies is steeper than that of the U.S.-based counterparts with a cheaper valuation. So I think there's more opportunity in overseas equities than there actually is in domestic, at least at the moment.
All right, we'll be watching that. Mark, good to see you, sir. Thanks so much.
Thank you, Maria.
Mark Luschini joining us there, Janney, Montgomery.